Hello, everyone. This is Stephen Richardson. Today, we're going to talk about estimating future price earnings ratios. If you recall, my last video was about estimating sales growth. Sales and earnings per share growth is estimated the same way, projected the same way. You go to the same sources and you write down the percentages, and you come up with your projected earnings per share. So, sales and earnings per share are done the same way. And we're moving on to price earnings ratio. This will complete your analysis of a stock and be able to show what it will be worth in 5 years. So this slide is a disclaimer slide. I'm not offering any financial advice to you. It's just purely for educational purposes. All right, so a refresher on the price earnings ratio. Price earnings times earnings per share equals price of the stock. It's very important, earnings per share, because we want some way to find apples for apples. So the price earnings tells us how much investors are willing to pay for $1 of earnings per share. That's earnings per share, EPS. A price earnings ratio of 12 means an investor will pay $12 for $1 of EPS. It allows us to compare the value of one stock, let's say it's priced at $1.35, to another stock priced at 80 cents. So I've got an analogy here. Got a large can, 15 ounces, that's $1.35. A smaller can, 8 ounces, not quite, a little bit more than half the volume, is 80 cents. So which is more expensive? It turns out the 80 cents is more expensive because it's 10 cents per ounce, whereas the other one is 9 cents per ounce. So the other one, 9 cents, is better for value. I mean, if you're grocery shopping, but the more expensive one is the 10 cents per ounce. This is how you compare a dollar of a dollar of stock for $1 of earnings per share. Okay. Stock A versus stock B comparison. Stock A sells at $20 with $1 EPS. Stock B sells at $100 with $10 EPS, earnings per share. Which is more expensive? Let's see. Stock A price earnings would equal $20 divided by 1, or a 20. Price earnings ratio 20. Stock B, $100 divided by 10, earnings per share, equals 10. With stock A, we would pay twice as much for a dollar of earnings per share. Price earnings can tell us if a stock is expensive. So here's raw data from, again, Walgreens Boots Alliance, Walgreens. It's from 2018. And so this is the stock selection guide. This is the valuation tab, the tab to the right of the first tab on the left. If that makes sense. And so I've boxed in some areas here. The high average price earnings ratio, average high was 25.5. And you can see they're pretty much all in line except for 2018. It dipped down. I don't think as much cost return, but you could cross out that year and it would raise the average price earnings ratio if you were concerned, but it's only 1 year. So we'd have to see what 2019 was like. And then the low average was 17.8 again, except for 2018. Everything else is, 2014 and 2015 high, and then it dips down, then it goes back up. Basically what the high did too. It was high and dipped down and went back up. So you could take 2018 out and figure your average from that. And then average price earnings ratio is taking that average high and average low and averaging it to give you 21.6. The current price earnings ratio is 13.3 right now. So that falls in line with 2018 because it started dipping down. Okay, so estimating the high ratio and potential high price. So let's say we were to choose 25 for the high, and recall I'm going back, the average high was 25.5. And this is in 5 years, keep in mind. With the current price ratio of 13.3, do you think it can get back up to 25? Possibly. So this is probably an aggressive approach to using 25. Might be more conservative to use 20. And then this is the high earnings per share. This is from your estimate. See, I got a little snip over here, $8.21 from what you estimated the earnings per share would be after 5 years. So you multiply those two together, and this is your high estimated high price of $205.20. All right. Now you estimate the low potential low price using a low PE. So here we've got 18. Remember the average low was 17.8. Can it go lower? It's currently it's at 13.3. Um, and 18 is kind of aggressive too. It's not conservative. Maybe 14 would be conservative. So you take their current earnings per share. Well, actually, it's from 2018, the most recent, not the trailing 12 months, and you multiply that by what you guessed the average low would be, and that gives you the forecasted low price, 90.9. Okay, why does this all matter? Um, you review historic price earning values from the stock selection guide, identify the outliers, like I told you, high and low ranges and trends. Maybe you cross them out with the red and then it recalculates. You consider the business cycle. Is it cyclical or is it steady? Like consumer defensive is steady because that's like foodstuffs, peanut butter and bread and that kind of stuff that ConAgra makes. Collect analyst future price earnings estimates. You would do that from Value Line, Morningstar, MarketWatch, Zacks, NASDAQ, and then set a reasonable range for future price earnings. Consider other influences on the price earnings ratio. Select supportable average, high, and low. What do you think can do it? And those guesses were kind of aggressive. They probably should have been a little bit more conservative. So, factors that affect the price earnings ratio: the company growth expectations, company quality, the higher quality rewarded with higher price earnings ratios, industry expectations, like Apple has a higher PE. Apple has really good products with their phones and their computers and stuff. So they get a higher PE. Beyond fundamentals, you look at interest rates, inflation and deflation, economy expectations, mood of the market. That all affects when you go into lockdown on COVID, everybody's gonna suffer for their price earnings ratio is gonna come down. And at that point, it's you can go bargain shopping to buy some great stocks that are undervalued and then watch them just start racking up over the next year, 2 years. So price earnings ratio comes down as growth slows. Okay, industry peer comparisons. In general, companies that grow more quickly and consistently tend to be awarded higher PE values than their peers. The same can be said of companies with superior balance sheets compared to peers. All right, what is inflation in the simplest terms? It's the loss of purchasing power. Since 2020, CPI has increased 16.6%. In September 2023, the CPI increased 3.7% year over year. Okay, historical Standard and Poor's price earning ratios. You can see the current 24.77 when this was snipped on Friday, October 13th, whatever year that is, probably 2018, 19, I don't know. And then it has the mean and the median. So this is always fluctuating, that current PE ratio. So the mean and the median will fluctuate too. But you can see they've been tracking it since 1870. And you can see roller coastering, then spike, and then way coming down, then spike. Uh, then the market crash, and then just a roller coaster, and finally in 1980 it starts to recover and goes up. And 2010 was awesome year. Okay, price earnings ratios and interest rates. Lower interest rates equals higher PEs. That's because fixed income investments, bonds, provide a lower return. So people put their money in stocks. Money will flow to where there's potential for higher returns, which is stocks. Higher interest rates equals a lower price earnings ratio. Fixed income investments provide a higher return for lower risk. The bonds, fixed income. If the Fed rate is 12%, then the borrowing, the interest rate will be around 14, 14 and a half, maybe 15%. So that would be good to put it in CDs. Investors inclined to take an additional risk of stocks. Okay, fear and greed. This is important. Fear can drive price earnings to unreasonably low levels. Panic causes many people to sell stocks, often at the wrong time. Greed can drive PEs to unreasonably high levels. Oh, it's different this time. It's really gonna sell. I got a hot stock tip from my buddy. Fear and greed cause investors to buy high and sell low, the opposite of what we want. We want to buy low, sell high. Okay, wrapping it up. So you can see here my little spreadsheet that I keep. I look at the 10-year earnings per share because that's going to help me with the PEG, right? And Walgreens current, Walgreens average 5-year, Walgreens average high, average low. And then I start looking at the sector, which the sector is consumer defensive. And overall, that sector is 15.6, and there's 6,688 constituents in that sector. Then the industry, which is pharmaceutical retailers, is 43.5, and our PE is much lower. There are 106 constituents in that retail line. Standard and Poor's 25.9. Historical levels, that's the current Standard and Poor's. Historic 15.7. The PEG is 2 times the earnings per share. So now you make your judgment for the high and your judgment for the low. And we kind of made a judgment they were kind of aggressive. So the sector PE might have a little to no bearing because there's so many industries in a sector. A low PE can indicate a bargain or a company in deep trouble. Higher PE is not common in rocketing growth stocks. Um, okay, let's go to the next one. So that's it, folks. Now you know how to estimate sales, estimate earnings per share, and price earnings ratios. You are ready to start investing. I would recommend taking your time and doing a few stocks, a few exercises, maybe some ghost stocks to see, do some picks and see how they do based on your research, and then jump in. Um, that's the only way you're going to learn is by jumping in and doing these over and over. If you liked what you saw, click subscribe, tell your family, tell your friends, tell your enemies. I also have two other channels: Backyard Musings, which is current events with edgy commentary, and Law School Dash Essentials, which is for law students to help them with legal law school exams and Cal Bar exam. Thanks a lot and have a great day. Bye.